Welcome to the Beginner Investor channel. The purpose of this channel is to provide short, to-the-point videos for new investors. When I first got into the market, I used YouTube heavily, and I just found it to be full of good information, but in very long videos with a lot of fluff. So I want to just try and cut right to the point. Disclaimer, I'm not a financial advisor. This is not financial advice. Let's get right into it. Trading styles for new investors. Like I said, when I first started out, I was completely overwhelmed. So many terms, so many strategies, technical analysis, fundamentals. It was a lot for me. So in picking a trading style, if you are getting into this and you are brand new to the market, I would suggest a passive style. So what is a passive style? Well, you're going to invest your money somewhere and you're going to leave it be. You can use that time to learn more about the market, to maybe watch individual stocks. But what you're going to do is you're going to pick a mutual fund, you're going to pick an index fund, you're going to pick an ETF, which we'll talk about later, and you're going to let your money be there, hopefully watch it gain, and not deal with the day-to-days of trading. If you feel like you know what you're doing, you've got a little bit of a handle on the market, or you just want to be an active trader, then you're going to be checking in daily, maybe weekly. You want to research individual stocks. You want to manage them often, and then you're going to look for an active style. So for passive investing, index funds is your go-to, most likely. You're going to pick a fund. You're going to hope it gives you a return over the long haul. It's a great place to start for passive investors. Index funds are market is going to be green over the course of a year, which, in my brief experience, it looks like it is most of the time, then you're going to be green. You're going to have returns. The question is, do you want to match the market or do you want to try and beat the market? Another great passive investing strategy is dividends. This can also be used for active investing, but if you're swing trading or day trading a dividend stock, you're not going to get the dividend unless you're swing trading over the course of months or something. But basically, what a dividend is companies are trying to make their stock more attractive to you by offering you a monthly or a quarterly return on your investment. So one of the stocks that I own is AT&T, and they have a quarterly dividend of 52 cents a share. So that is money that comes back into my portfolio that I can reinvest depending on how many shares of AT&T I have. And it's a great little kickback. It's a nice incentive to be into AT&T if I believe in a good company. There's no point getting into a dividend company if it's just going to, if the overall stock price is just going to plummet because it's not a good company. Then sure, you're getting a nice little dividend, but your share price is also losing value. So overall, you're probably losing more money than you're actually getting from the dividend. ETFs. This could be passive or active. These are called exchange traded funds. So basically, it's a group of companies put into a single fund and then it's bought and sold on the market. So there's an ETF portfolio right there on the left-hand side. So like a technology ETF, you see Apple, Uber, Netflix, Microsoft, Amazon. There's a large cap ETF. A lot of people are talking about Cathie Wood and ARK Invest. She has several different ETFs, but something that I didn't know when I first got into it is expense ratios. So, for instance, the ARK ETFs all have an expense ratio of 0.75%. Now, a lot of index funds you'll find maybe 0.15%, 0.30%. So these ARK ETFs are up there in terms of expense ratio, but they have proven to have great returns. So if you want to basically bet on the professionals, I'm assuming, at ARK Invest making you money, then you can buy into their ETFs. They have a financial one, they have a technology one, there's several. But you pay the expense ratio. It's not something you pay at the end of the year or at the end of the month. It's factored into the price of the stock. So you never see it come back out of your portfolio. But basically, you can see exactly what ARK Invest is investing in, and you could just make your portfolio match the ETF. It's just a group of companies that you have access to as well. So if you want to avoid the expense ratio and do the tedious work, you can invest in the same thing the ETF is investing in. But again, it's tedious. You have to match the percentage perfectly to your portfolio to get the same returns. So if you want to just avoid the hassle, you can invest in the ETF. For active investors, this is one thing that I did not realize when I first got into the market, and that is catalysts and just how much movement they can create. So this would be anything that causes the price of a stock to go up or down. And some of the common ones that I wasn't thinking about is maybe the launch of a new product. FDA approval is a big one for the buyout stocks. A big investor. So, the other day, Warren Buffett dropped a ton of money into Verizon, right? And that caused all the buzz about Verizon to pop up on YouTube. Earnings reports. This was a big one for me. I assumed that positive earnings reports would automatically be an increase in stock price. I learned that the hard way with Apple, who in Q4 of 2020 beat their expectations only to see the price plummet. I mean, plummet is an over-exaggeration, but only to see the price drop 5–10%. I mean, I got in it assuming that they were going to beat earnings. They did. I thought I was going to be sitting pretty, and I'm not. So earnings reports can be good or bad. It's difficult to predict what will happen with the earnings reports. News stories can be good or bad. Insider sales can be bad. Insider buys can be good, and then lawsuits can be bad. One of the stocks I got for opening my Webull account was ADT, and literally the day it hit my portfolio, it takes a couple weeks for Webull to process it. It hits my portfolio, and that day they got sued by Vivint. So the price plummeted 20%. Unlucky. Indicators, these are great tools for active investors to start learning. They help you to read the price chart. So suggestion for new investors is probably just to start with RSI and watch how that works. Anything over 70 is overbought and generally means it's overvalued and it needs to come back down at some point. Anything oversold is under 30, and that means, hey, this is a good value and it's probably not going to stay down here for very long. So if you really believe in the company, you like the fundamentals, you like the future of the company, and you find it under 30, that means it's probably at a great value and you should consider getting into it. Technical analysis. This is basically looking for patterns or movements in the price action charts. There is no guarantee. There are some bullish patterns, there are some bearish patterns, but the price action can go whichever way it wants, and nobody can predict it. Otherwise, they'd be loaded and they'd be selling you how to read price action charts, how to predict the future, and it'd be magical. My suggestion is a YouTube channel that I found called Trey's Trades. He does great technical analysis that even myself as a beginner can understand, and I highly suggest it. If you found this to be helpful, please consider subscribing to the channel. I hope to put out several more videos to help new investors along the way. Hit that like button below. Please leave a comment. There's also a link below to a Webull account opening. If you open a Webull account and put $100 into it, you get 2 free stocks. And if you click that link and use it, then I get 2 free stocks. It's a great way to support the channel. It's a win-win for both of us. Webull is a brokerage account that I highly recommend. I have an account with Webull, and I have loved the app. I like the interface. I like the way it works. So highly suggest it. Have a great day.